Just because we're in a bull steepener doesn't mean go out and sell, but it does mean you have to evaluate what you own and think about what what type of stocks you want to own, what type of bonds you want to own, and how does that fit into the environment that we appear to be entering into, which the Fed kind of knocked the champagne bottle on the SS economy. We're in a new regime, Adam, and that's what, you know, things have changed. The Fed, I think officially the Fed christened it today, but the yield curve is telling us that we've been entering this new regime for a couple months now. So pay attention, understand what you own, understand how those things that you own perform in different economic, different monetary policy environments, and adjust accordingly.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of yet another week for another weekly market recap. This time, not featuring my friend Lance Robert, but featuring my even better friend, Michael Lebowitz. Michael, how you doing?
Doing great, Adam. Thanks for having me.
Thanks. Yep, had to get my normal dig at Lance in there. But that being said, Lance is actually helping me out. The reason why he's not here for the regular weekly market recap is because on a Friday, the day before this recap, when we normally film it, I'm grabbing him for another event, Substack. Folks know I've got a Substack, but Substack is launching a new live video service, and they tapped just a handful of content creators to basically produce live events that they're promoting throughout this week's launch. And Thoughtful Money was one of the very few that they tapped, and we're the only financial one, so it was a big honor. And so I grabbed Lance to do that with me. So hopefully some of you might have actually seen that on Substack, because this video is going to air the day after. But anyways, I can't beat up on Lance too much because he's doing me a solid. And you're doing me a solid, Michael, by stepping in his absence. So thank you.
It's my pleasure. And what a day to do this.
What a day to do this. So yeah, crazy day. We're recording this at the end of the day on Wednesday. So folks, we're not going to have, insight into the market action on Thursday or Friday of this week. Again, that's because of both the Substack thing that's going on, and also tomorrow I'm taking my youngest daughter, my last child, to college for the first time. So couldn't record on that day either. So sorry, we're kind of teasing you with the news, which is that the Fed just announced that they are lowering the federal funds rate by 50 basis points. In terms of what impact that has on the markets and whatnot, I'm going to have to pick that up next week with Lance. But Michael, let's roll up our sleeves and dig into this, because this is the big elephant in the room right now. The Fed has officially pivoted after, I would say, a year and a half of the market predicting, expecting it was going to imminently, but it finally did.
Right. They finally moved. They voted, a lot of interesting things with this. First of all, they voted 11-1, so there was a dissenter. And that was the first dissent since 2005. So I'm not making too much of it, but it's just an interesting fact. I think the big story is they went 50. If we would have been talking a week ago, I bet the last time you talked to Lance, he told you the Fed was going to go 25. A week ago, I would have said the Fed was going 25. Some point earlier this week, the Fed funds future market started pricing in 50. And it was, a couple days ago, it became 2/3 of the odds went to 2/3 that it was going to be 50. Of course, a couple days ago, there was also a Wall Street Journal article by Nick Timiraos that basically laid the groundwork for 50. So the way the Fed operates is they go into a blackout period about 10 days before the Fed meeting, and they can't really say anything or leak anything to the press. So when the last thing they want to do is shock markets. Typically, the last thing they want to do is shock markets by doing something the market doesn't expect. So what they did this time was leak the fact that 50 is a distinct possibility to Nick Timiraos. And the market was, by the time they actually went 50 today, it was not a shock. I would have been stunned a week ago. Today, it was kind of as expected. So interesting way of doing business, but that's the Fed.
Boy, that is interesting. And you pretty much attribute kind of all of that shift in probability, the market's expectations of the 50 basis point cut, to that single Nick Timros article?
There was really nothing else to accredit it to. You really have to look back at data, and CPI was pretty much on the screws as far as expectations, but you could argue maybe slightly higher than expectations. The BLS data, JOLTS data was 2 or 3 weeks ago. So we heard the Fed opine on that data. So there was really nothing economically, nothing in the financial markets, nothing in the currency markets to not go 25. Why not go 25? But the Fed obviously must have some regret they either didn't go 25 in July, which Jerome Powell alluded to today to some degree.
I don't think he alluded to it. I think he admitted to it. I think he
He
said,
admitted
if
to
I
it.
could go back in time, I would have cut then. Yeah.
Yeah, right. So, it's I think this comes down to something last time I was with you, I harped on, I've written a few times. Fed funds are way too high. That's the bigger problem. Inflation is quickly moving down to 2%. Whether it gets there in March of next year or July, we don't know, and I'm not sure it really matters. Inflation is heading down. The annual rate of inflation is heading down to 2%. And with that, Fed funds should be much closer to 2.5 to 3%. Prior to today, they were 5.25 to 5.5. So, if I were Jerome Powell, I probably would have taken a slightly different stance with today's press conference, and I would have harped on continually, Fed funds are too high, and we're just normalizing them. He did say we're normalizing Fed funds a few times, but he really didn't harp on that. He seemed to harp on the fact that the labor market and their confidence in inflation getting lower are now back in balance, and they need to kind of judge them equally as they decide what to do with rates.
Mm-hmm. All right. Well, look, I want to talk about both the implications of the fact that A, we've cut, B, we've cut by 50 basis points, and C, whether this is a movement of strength as Powell is publicly positioning it, or whether it's a movement of concern and the Fed is trying to get ahead of something or trying to catch up to something.
Right.
But real quick, I want to get back to my question about Nick Timros and just say, I know you sort of gave a nod to this in your comment of a crazy way to do things, but yeah, the fact that we have arguably the most important institution in the world, when you think about the number of things that get impacted by its decision making, communicating, basically to the world, in a whisper through one person, is kind of bananas. I mean, in the Fed will talk all day long till they're blue in the face, like they did today, about how there's no political influence or influence about the market and their decision making, but obviously they take it all into consideration, right? They wouldn't be doing this if they weren't doing that. So, I mean, it is the system, I guess, that we have, but I just want to note that it is a crazy way to run, the U.S. economy and by connection, the global economy, given everything else that's impacted by this.
Right. Now, Adam, there is another consideration to think about. The Fed went onto their blackout, let's just say 10 days ago, September 8th. They had ample time after the BLS report to tell the market they were considering 50, right? They didn't need to leak it through the Wall Street Journal. They could have said it at the time, but they didn't. They really weren't saying we're going to go 50. And the market was primarily priced for 25 based on everything they had heard from the Fed. So what changed over the last 10 days that the Fed felt they had to go 50? And accordingly, because the market wasn't expecting 50, leak it to the journal. And that's, something to think about. And to be honest, I don't have a great answer, because we know the BLS survey that they do to come up with the numbers in a couple of weeks is, I think it's done on the second week of the month. So that just happened. It's hard to believe that the BLS has enough data in hand to tell the Fed, or to even feel comfortable telling the Fed, that this or that happened to the unemployment rate. CPI was, what was that, a week ago? Um, so there's really no data to speak of. So the question, I think we're all left to wonder is, did something change materially over the last 10 days, or is just part of the game the Fed is playing? But they could have easily prepped the market for this on their own. They didn't need the journal, except that the time to prep was within the blackout period. So just something to think about and kind of question.
Yeah, and it does raise that question I mentioned, which is, so is this coming from a point of strength or is this coming from a point of concern? Obviously, if you talk to Powell, you listen to Powell, he says, "Oh, this is coming from a position of strength." He actually, I wrote in my notes halfway through, Powell's kind of delivering like a mission accomplished speech here, right?
But he purposely said, I'm not delivering the mission accomplished, because
That's as
I
he'd say.
was with you,
Yeah,
because I know he was
I'd written
going
that
down that
down, and then
road.
near the end, yeah, he backpedaled and just said, "Hey, in case anyone thinks I'm saying mission accomplished, we're not quite there yet, right?" But really, pretty much the bulk of what of his excuses were like, "No, like we've really got inflation down to where it needs to be, and hey, yeah, the jobs market has normalized, not weakened but normalized, and in fact, that was the plan. We were trying to cool off the labor market to get inflation under control, and 4.2% unemployment is still really good, right?" So he was basically saying, hey, the reason why we can do a 50-point basis cut is because we kept rates high for so long, we got inflation under control, jobs stayed in a good place, and now we can take a big move like this and not have to worry about disrupting the system. And I guess you can, you can take it that way. But then, and a lot of the reporters were kind of hammering on this, which was like, well, wait a minute, 50 is kind of a big jump. You have this descent. You haven't had a descent for, almost 20 years. And a lot of questions about the jobs market, and like really needling him, like, hey, but are you concerned about this? Are you concerned about that? And the one sour note that Powell made that stuck with me was, the New York Times journalist said, hey, your current projections now show you've revised upwards your unemployment projections for the end of the year. It's going to rise to 4.4%. But then you have it staying there. And something that I've commented many, many times on this channel is, if you look at the unemployment rate, the pattern is really pronounced across history, where after we come out of a recession, the unemployment rate comes down, it gets more and more quiescent, it just bottoms, it hangs out there. Once it starts to tick up, it then explodes, right? So basically, she said that, and she said, why do you think it's going to be different this time? And he said, well, the jobs market and the economy are in good shape, and we want to keep it there. And kind of like, oh, all right, that's kind of like a hope. It's not necessarily a rationale or a plan. And he really just kind of moved on to the next question. And so, I will say too that back in July, there were a lot of questions, much more pointed than had been in the previous conferences, about the jobs market. And Powell kept saying, no, we don't see any sign for worry, we're cool. But all of a sudden, the tenor of this report was, well, yeah, we are seeing some, everything's okay, but we are seeing some trends that we're keeping an eye on, and the downside risks to jobs have increased. So he's kind of admitting that the Fed kind of got jobs wrong in July, and that may be part of the reason why they're making the big 50 basis point cut. So, I'm not necessarily calmed by Powell's explanation so far.
No, I agree with you. I think there is more concern about the labor market than Powell or the Fed is letting on. So I think that's one reason they were more aggressive. He also, to exactly what you said, he didn't answer the question that was asked him 5, 6, 7 times. In fact, the last reporter, I think from Yahoo, I thought asked it the best way. You keep dwelling, you keep saying that inflation is getting pretty close to target, and you keep saying you're concerned about the labor market, but why do you keep saying those two objectives are in balance? And, he kind of danced around the issue again. But I think you're right that labor is what matters. So what that means from an investment point of view is that Now the first week in October is going to be the week that matters for markets. That's when we get jolts. That's when we get ADP and ultimately the BLS report on that first Friday in October. So any data outside of those three that has to do with employment is going to be scrutinized much more than it probably would have been. So that may be things like the University of Michigan survey, the ISM manufacturing and servicing reports, all the regional Fed employment indices. Those are the things that we now have to pay closer attention to. And you made a great point about the unemployment rate. It's basically either going up or down. It doesn't just go up a little and just sit there. When it goes up, it goes up. And maybe this time will be different. You never know, but odds are it's not going to be different. And the unemployment rate is heading higher, and the Fed's doing what they can to try to stimulate the economy.
So I was appreciative of the journalist. I'm trying to figure out from my notes here which one. Oh, it's from Politico, who basically brought up the lag effect, and basically sort of asked the question that I would have asked, which is, hey, okay, so you're making a 50 basis point cut right now. It's going to be a good while before this has any impact on the broader economy, right? So even if you're kind of concerned about the trends in labor right now, and that's why you're making this big cut, it's going to be quarters, maybe a year plus before this really starts riding the rescue. And in the interim, we've got the lag effect from these higher for longer rates that's likely still arriving, right?
Oh,
And,
yeah,
and will continue to
absolutely.
arrive. Yeah, yeah. So how concerned are you? I don't ask a leading question, concerned, but what impact do you think, if any, the lag effect from higher for longer is going to have, in the lived experience of us Americans over the next year?
I think there is a still lag effect, we'll call it a headwind to economic activity. And then the other important part of this is that interest rates have not really affected as many people as is typical. So what do I mean by that? Not many houses were bought or sold over the last couple of years because rates were so high, right? We know housing activity was deeply diminished. So the average mortgage rate, for instance, is still, I think it's like 3.25, 3.5. Typically, lowering rates would spur mortgage refinancing. And when you refinance your mortgage, you go from pick your payment, $1,500 a month to $1,300 a month, and you instantly have $200 to spend on something else. That's not going to be the case. The amount of people that can refi today that couldn't refi a month ago is very small. And it's going to take a significant number of rate cuts to get to the point where people can refinance their mortgages and get some extra spending money that's material to the economy. Same is true with corporate debt. There was a ton of debt issued in late 20 and early 21. So companies effectively refinance their debt loads at very low rates. Now, some of those are maturing and they have to be refinanced at higher rates. But over time, you have to get rates all the way down to where they took on that debt to have no material, to have no material effect. So even if rates keep coming down, they're still above where the old debt was. And again, it's going to be like a headwind when they have to increase their interest expense. So, I think the Fed, the immediate effects of 50, 100, 150 basis points, the marginal effect is going to be much less than it has been in the past because rates have been where they're at and because the effect has been a lot more minimal than it otherwise would have been. So, if this economy is truly slipping into a recession, the Fed's going to have to act, dare I say, violently. So by that, I mean 50 and 75 basis point rate cuts become the norm. Now, we're not there yet. The economy is still fine. But, if things deteriorate, the Fed can't afford to just sit by and cut 25, maybe 50, 25, 25. It's going to take some pretty sizable cuts to let rates stimulate the economy and offset some of that headwind from the last time they raised rates, last few times they raised rates.
Okay. What was interesting in the press conference, as you saw, everybody was poking him to say, well, okay, you just did a 50 basis point cut. Should we expect this to be sort of, setting the tone for an aggressive, fast rate cutting program from here? And he kept just saying, oh, don't expect anything. We're just going to take it meeting by meeting, whatever. But you're saying, and that's a great point, right? Which is that the usual relief we see from, pulling a rate cut doesn't really apply to this type of Frankensteinian system that's been created here by the Fed, because we have both corporations and so many homeowners locked into these very low loans. And, until we get down to that trajectory, it's not really gonna matter that much, at least not to the majority.
Right. No, Powell did say something very important and very humble. I think the question was, what are mortgage rates going to be a year from now?
Yeah.
And he said, I have no idea.
Right.
He basically said, we don't know where the economy is going to be a year from now. So I don't know where interest rates are going to be a year from now. I mean, there's a ton of variables, but what he's saying, and this holds true not just for the Federal Reserve, but for all the Wall Street economists that seem completely confident that they know exactly what's going to happen in the future. To everyone else, none of us know how this is going to play out. And it could be hunky-dory and we could get that nice soft landing that the market is on board with. Could be a crash landing, or, I don't see how, but we could get a reacceleration of growth. So, again, the Fed is taking it month by month, looking at data that they're very, he uses the word data dependent, must be 30 times. And that's, as investors, that's what we have to do as well, be data dependent and understand the trends that are occurring.
Well, and that I think is the real opportunity and real challenge here. And it's why we have you and Lance, on this program every week. I keep going back to the title of David Stockman's book from like 15 years ago, coming out of the GFC, where he called it The Great Deformation. And he was trying to explain what led to the global financial crisis and then all the QE programs that came out of that, right? And I think that term deformation is really accurate. We just really deformed the system so that it started acting in ways that were unnatural to the natural design of the system. And to your point there, so it just makes it harder and harder to say if A happens, then B should happen as a result, right? And a great example of that, relative to the example you gave, is if I had gone back in time, Michael, and told you right at the start of the Fed's hiking campaign, Michael, they're going to take interest rates from pretty much near zero up to 5.25. What do you think is going to happen to home prices? Right, if I'd say mortgage rates are going to zoom up from 3 something to 7+%, what's going to happen to home prices? I think you would have mortgaged everything. You would have put all the chips on home prices are going to come down, right? And they didn't. Right. And so, something that even we had just bulletproof confidence in, something different happened. So to your point, we have to be very humble here that the things that we think, may happen, very well may not. So taking that sort of active investing, watching everything on a day-to-day basis and making adjustments as necessary, I think becomes really, really important.
And the other part of it is just understanding all this data that's thrown at the market. Appreciating that what really matters are trends. Not, we have this discussion with inflation all the time. You ask anyone on the street, is inflation bad? They'll say, yeah, it's awful. The price of bread is up 30% over the last, 2-3 years. But you ask an economist, they'll say, no, the price of bread hasn't changed in a year. It's great. There is no inflation. And regardless of what you think of the price of bread and inflation, you have to put on the economist mind and look at this data and be able to dissect it. Within the BLS employment report, there are hundreds of numbers. What you get, what without even opening the report, what you'll see in the New York Times and the Wall Street Journal and all the major newspapers is the unemployment rate and maybe the number of new jobs added. There's a host of other data that can really tell you what's going on. And then you have the JOLTS data, which will never make the front page of any major paper, or ADP or ISM, and countless other data. So, it's we've as investors, we've to survive, we've had to become economists and really understand data because at the end of the day, the Fed drives liquidity and the Fed is driven by economics. So if you don't understand economics, you can't understand the Fed. And it is what it is, but that's the state of markets today. And as an investment advisor, that's what we have to spend a lot of time on to try to get inside the head of Jerome Powell.
Okay, well, as an investment advisor who does that, one of the conclusions that you and Lance reached, a year plus ago, was that hey, the Fed is eventually going to have to pivot. It's going to have to get rates down. You were looking at implied inflation expectations from the market and seeing that they were coming down, and basically said, okay, interest rates are a function of inflation expectations. We think interest rates are going to be coming down commensurate with all this, and we want to get out in front of that, and we want to get into longer duration bonds, specifically a lot of longer duration U.S. Treasury bonds. I guess I got to imagine today's Fed decision is playing according to script, I guess, for lack of a better word, from what you guys have predicted. A, is that the case? And B, where do you see the knock-on effects here from this pivot being for bonds going forward?
So I think I've been trying to write this article. I'm struggling with it, but it's called, my working title is Inflation PTSD. And the gist of it is that investors have PTSD over inflation. It's exactly what I just said to you, that most people think the price of bread is up 20 or 30%, therefore there's inflation. And we're so scared there's going to be more inflation. We just lived through this horrible event. The odds are that there's going to be another horrible event. And yeah, I'm not making this, is inflation and PTSD are two different things, but inflation is deep in our memories. And I think as investors, as consumers, we're so scared it's coming back. And because of that, bond yields are slower to fall than we thought they may have been. But the fact of the matter is that inflation is coming down. We don't see any reason for a spike in inflation other than something unforeseen. Which, obviously, as we saw in 2020, the government can create inflation if it wants to. But economically, based on trends from the last 30 or 40 years, the trend is lower. And I think we're being sucked right back into that trend where the Fed's going to struggle to keep inflation at 2%. And if you can get bonds at, now they're below 4%. We were saying this at 5%, but
Right.
at 3.5, 3 3/4, I still think you're supposed to jump on them and ride them down to, 2%, 2.5, 1.5, wherever they end up going, and essentially locking in some of those higher yields, because inflation, I think the Fed has had their mission accomplished moment. They've succeeded, even though the inflation rate is not quite down to 2%. And actually today, I'm sure you heard this when someone asked him about real estate prices within CPI. He is telling you that shelter prices lag within the CPI calculations.
Right. By
And
even more than he expected, he said.
and
Yeah.
he gave you the magic the magic data point. Again, there's another one of those data points that you'll never see reported anywhere, but it basically measures new rents. So if I go rent the apartment across the street, what was my rent and how did that compare to a year ago? Or if I've been in an apartment for a year and I'm getting my rent renewed, how does my new rent compare to my old rent? That tells you the marginal change in rents. Everything else is just noise. And there's a lot of noise in those CPI reports, and it's going to take a while, longer than is typical, but it will happen. And CPI less shelter is down now over the last 4 months. So if you strip out shelter, CPI has been negative. We've been in deflation for the last 4 months without this bogus indicator that Jerome Powell told us lags, that we know lags, that most economists tell you lags significantly. So, it sounds crazy, but it wouldn't shock me if a year from now we're hearing the Fed bemoan that there's not enough inflation. Now, I don't think publicly they'll do that after what we've been through with
Right.
inflation, but I think behind the doors, that'll be what they're saying.
Right. And of course, that was their saw, right up until inflation, the genie came out of the bottle. But for
Right.
years, Janet Yellen complained about too little inflation. Um, all right. Well, look, I want to talk about some of the other knock-on effects besides just bonds, but really quickly, just to your point about inflation, Powell kept saying, the economy is doing well. I said it's growing at above 2%, and we project it to continue to do that in the years going forward. Um, and what I didn't hear this time was, and the consumer is remaining resilient and strong, which he generally sort of slips in, or has slipped into past ones. That wasn't really here. And he did, he's done this before, but he did take pains to say, in the Fed, we work for the American people, and we understand that's why price stability is so important to us, because we understand how much losses purchasing power really, really hurts people with cost of living. Um, uh, but he's trying to tout how strong the economy is. He then said, one of the examples he used was retail sales. We just got that, that new retail sales number that shows strength in the economy. Well, that new retail sales number, which was a positive surprise, was retail sales, what, Michael, grew by 0.1% in August, and they were expected to have been down. So like, okay, great. We got a green number, not a red number, but like 0.1%, growth is not something to really be like beating your chest overly about here too. And kind of where I'm going with this is, Powell did say near the end, gosh, where was it? What would he say to the American people? And he basically said, like, hey, what would you say to frustrated home buyers? He said, well, we had a global burst of inflation and we had to raise rates to deal with that. That was a necessary response. Yes, it was painful, but be thankful that we're getting your worries about inflation put to rest, right? He was kind of like, hey, like you guys should be thanking me here now. Inflation's only 2%. Now, the thing is this goes to your earlier point about economists versus real people. Like I just did a poll on Twitter and said, okay, look, headline CPI is now at 2.5%. What has been your household's observed increase in cost of living over the past 12 months?
Oh,
And as you can imagine, Michael, way higher, right?
way higher. And look, I may come off as being like, oh, I'm an economist and I know inflation's only 2.5 or 3%, but I'm also a consumer and a human being. And I go to the supermarket, I go to restaurants, and I complain. Every time we go out to dinner, I complain to my wife. I was like, what did we just do? This was 100 something bucks, and it wasn't, anything special. And, so even for people that are kind of thinking like economists, it's still a memory, and it's still a fact of life that things cost a lot more today than they did a year or two ago.
Yeah, so that's kind of where I'm going with this, which is things cost an awful lot more than they did pre-COVID, right? So, it's been 4 years, but 4 years isn't an eternity. It's
No, it
not that
flies
long
by.
ago. Yeah, and I pulled the Truflation numbers up a bunch that show that they're calculating the inflation that's happened since January of 2020 is now somewhere between 25% and heading towards 30, right? So basically, over a quarter of the purchasing power of our dollars has vaporized in just the past 4 years, right? And again, my question on Twitter was, how much has your cost of living increased over the past 12 months, right? And people are saying anywhere from between 8 to 20%, right? So it maybe it is disinflating from a year or two ago, but it is still really quite high. So kind of where I'm going with all this is Powell's saying, don't worry, everything's under control. Inflation's, practically tamed. Job market is still pretty good. Economy is strong, growing. But we're a 2/3 plus driven consumer spending economy. the consumer definitely seems to be continuing to struggle here. And, you know better than I, the bad earnings reports of all the consumer discretionary companies that are out there, even some of the staples companies are struggling. That we're seeing the dollar stores shut down. I mean, there's a lot of signs here that the consumer is tapping out. So that obviously could be setting ourselves up for a very different future than what Powell seems to be trying to tell us to expect.
Yeah, and I think along that side, we've changed our habits. Like like my wife and I personally, we don't go out to eat nearly as much. We didn't go out a lot before, but we've cut back a lot. Like now it's okay on a Friday or Saturday night. Let's just make something. It's cheaper and so there's a lot of people's habits are changing, and those are habits that grossly affect the economy. Consumer spending is 2/3 of the economy. So as people make adjustments to their spending, it's going to have big effects. And I think, other than the uber wealthy, almost everyone is making adjustments. We know that the lower class is just getting pounded. They're struggling to make ends meet. But to some degree, we're all struggling. We're not able to save as much. If you're wealthier, you can't save as much as you used to. You can't buy as many nice things as you used to. So we're all cutting back to some degree. And you go back to that retail sales report that was up 0.1%. Keep in mind that inflation was up, let's just say 0.3%, 0.4%. So that gain was a sole function of inflation. Without inflation, people are spending less money. And that trend has been going on now for about a year and a half. And that's what makes everything from a market perspective really hard, because most figures don't include inflation. They don't make it real or less inflation. And it can make economic data look a lot better than it is. And retail sales is a great example of that.
All right. Well, look, I want to get into kind of what you think the market action is going to be falling out of this rate cut. But real quickly, maybe just a super quick detour. We were talking about housing earlier, and I raised the point that mortgage, interest rates went down in the ZIRP era. That really inflated housing prices. So mathematically, and that's the mathematical relationship, right? The seesaw between interest rates and price. And then mortgage rates shot up because of the Fed's hiking program, and yet prices stayed high and have crept even higher, right? And I think part of that's because of the dynamic of the markets, right? Basically, transaction volume just cratered. And so a lot of the houses that are trading amongst those that can still afford to buy these prices. So you have a much higher composition of wealthier buyers, driving the price action. At least that's my thesis here. So now everybody has the impression that, okay, rates come down, mortgage rates will come down, and home prices will go up even further, right? In their minds, there's no equation where home prices come down, right? But I do wonder, could we actually see the inverse here? If low rates cause transaction volumes to start increasing here, could that bring additional inventory onto the market? And we find that kind of, if we begin to get truer price discovery with a wider base of buyers, could that actually start, leading to lower prices? And one example of this is a lot of people feel trapped in their homes, right? They feel like, hey, if I sell my house, it's going to cost me more when all is said and done to buy a new home, given where mortgage prices are right now. So you got a lot of, I think, boomers who probably would downsize to a smaller home if they could get it for a better price. Maybe what happens from here, at least for some period of time, is we have a lot of activity at the lower end price of the market with new, first-time home buyers and downshifting boomers. But the boomer, more wealthier homes really start cratering in value because finally the market's on thawing here. That's just, again, another hypothesis, but what do you think?
I agree with you. I think the boomers are there's waiting supply to come onto the market. And part of the reason that that they can't really sell their houses is because they don't want to trade in their 3% mortgage for a 7% mortgage. And, in doing so, even though they buy a house that's much less than the house they sold, their mortgage payment could be the same. They're like, why would I make the same mortgage payment for something that's clearly worth a lot less than what I'm selling? So as rates come down, I think more houses are going to come on the market. And then the question is, how much pent up demand is there really? Uh, and I'm sure there's some,
Yeah.
but
Although I don't think there's a ton at the higher end of the market, to be
no,
honest.
no, because again, the whole notion that house prices are doing this or that in this kind of market is it's almost like in the pre-market, in the after hours market. Sometimes you see these stocks that are moving up and down by 50 cents or a dollar. They're big moves for stocks that typically move a penny at a time. And it's because the market's illiquid. So just because one of these stocks moves up or a couple bucks, it's not worth anymore. The next trade is going to bring it right back down. And I think that's what's happening with the housing market is that there's just so few houses trading that you don't really have a sample. And I think like you said, a lot more houses in the upper end are trading than those kind of in the middle or lower end. So there's naturally some price appreciation because your sample size is higher price houses. So it's very misleading market right now. And we're going to find out. Mortgage rates are down in the low sixes now. My guess is you get them down to 4.5, and we start seeing a lot of activity, both demand side, but probably more problematic on the supply side.
All right. And I'm just going to mention this again here. I mentioned it in the past, but we have a lot of seniors or retirees and people 45 and older are the majority of the viewers of these videos. So I'm assuming we got a lot of people here that are homeowners and maybe in this cohort we're talking about where, hey, maybe it's time to downsize. I've mentioned in the past that right now homeowners are kind of trying to collude, right? Like, hey, if we just hang tight, the Fed will eventually ride to our rescue. They'll bring mortgage rates down, and then we don't have to realize lower prices here. And I've said, if people start doubting that, either doubting that the Fed is riding the rescue, which they're probably not now because the Fed just made this rate cut, but now if they're wondering that, okay, for the reasons we're talking about, there might be downward pressure on home values of the type of home that they own. There's a first mover advantage to bolt from the herd, right? To be one of the first sellers, right?
Right.
Because there, hey, maybe you'll lose 5%, 8% of your equity because you discount to get out, but you don't ride it down, right? If indeed there is a big change of trend. And so just be aware of that, right? Because if what Michael and I were talking about here happens, and I don't know if it's going to happen or not, but I can certainly make the case that it could, you're going to start seeing softening of prices at the higher end of the market. And, those that bolt early will bolt best. And those that wait, if it turns out there's a 10 or 20 or more, correction there, you don't want to be the guy that rides that all the way down.
Right. I would also be interested to know how much of people, let's say 60 and older, how much of their retirement nest egg is the equity value of their house?
It's for a lot of people, it is
I,
very material or the majority of it. Yeah.
I would guess 70, 80% on average, and I think that becomes very problematic too, back to the consumer problem. If, the Fed has sworn by the wealth effect and the stock market. And as your wealth increases, even if it's just on paper, you tend to consume more. As your wealth decreases, you spend less. Makes sense, right? It's logical. Well, if people are now saying, well, my house was worth X, now it's worth, 85% of X, I don't have as much money as I thought I did. We have to start cutting back because we're not going to be able to live to the ripe old age of 85, 90 and have money left. So they're given that the cohort of baby boomers is so large and disproportionate to the rest of the population groupings, what happens to them can steer the economy. So I think housing prices is a much bigger deal today than it probably was in 2008.
Okay. Well, it's going to be super interesting to see what happens here. And obviously, folks will be tracking it here on this channel, both with Michael and Lance, but also with the real estate experts that you see me bring on the channel frequently. All right, so we talked about bonds, Michael. What do you think in general the markets are going to do with this news here? And again, that would have been great if we had Thursday and Friday to be able to see the market action on that. So folks will have that data by the time they're watching this video, but not for the next 2 days, but for maybe the rest of the year from here. How do you think markets are going to interpret this?
Um, I think initially we could see, this is good news, the Fed's cutting rates, but I think the market's going to quickly realize that the Fed's cutting rates for a reason, right? They didn't cut them for the last year. They're all of a sudden cutting them and aggressively. And I think people are going to start asking why. And look, we know that rate cuts are almost always bad for the stock market. And why should this time be different? And I don't have an answer to why this time should be different. So I think, let's get past the next 2 weeks for the initial market reaction, and let's see what the reaction is going forward. And I just think the market's going to struggle here, certainly through, at least to the election, because you've just introduced another, we don't even know who the president's going to be. It's a toss-up between Trump and Harris. And there's such political division that whether it's Trump or Harris has such ramifications for the way our mindsets and the way we think about things. Now you throw the Fed into the picture, and I think you're creating a lot of consternation among investors, a lot of risk averseness. So, I think it'll be interesting, but I think the markets will kind of struggle to keep going on to record highs. They may not fall out of bed either, but I think we're kind of in a period where you get a decent amount of volatility, but we don't really go anywhere. And I think those are very tricky markets for investors to handle.
Okay. Well, not only does that make sense to me, but it complements the outlook of a number of folks I've had on this channel recently. The most notable one that comes to mind is Jim Carson, who his specialty is focusing on volatility. And, he says, hey, we are transitioning from a regime of, kind of very quiescent volatility to higher volatility. He believes it's going to run through the end of the year, maybe into the first couple of weeks of the following year. He does take care to say that doesn't necessarily mean lower prices. A lot of people think has to be an inverse relationship between the two. That's not the case. And he can make an argument for rising prices throughout this year. He's not necessarily saying that's going to happen. He's just keeping himself open to it. But the thing that he is very confident about is that volatility should be on the rise for the rest of this year for many of the reasons that you just mentioned there.
Late 1998, 1999, volatility rose consistently through that period, despite prices surging higher.
Yeah.
So investors were becoming more risk averse, but at the same time getting more aggressive on their bets. So they were hedging at a greater rate, but buying more and more stocks as well. So, you can make a case for that, that stocks do kind of rise up through year end. But I do think volatility will be a little more pronounced, certainly than it was earlier this year. And we could get these spikes in volatility like we've seen over the last month or two.
Yeah. And, Lance was pretty vocal in calling for the markets to de-risk and there to be an 8 to 10% correction, heading into the election.
Right.
Then, of course, we had the volatility of the past, month and a half. I basically said, well, I think maybe we already got the correction out. We'll know for sure when we have Lance back on next week. But obviously that'll be dependent upon what happens in the election. If the race starts to blow out, that's obviously going to have some implications. If it gets even tighter, that's going to have implications. So, we'll see what happens there. So one thing I should have asked you when we were talking about bonds, and we've talked about it. I think I asked you this question the last time you were on, but I'm going to ask it again now that we have the 50 basis point rate cut. We have had so much investor capital, and I'm going to assume a lot of the capital of the investors watching this program, put in the T-bill and chill trade. You have warned that that's not going to be around forever. The Fed is now officially pivoted, and is saying further rate cuts are coming, TBD on the pace.
Mhm.
They were pretty big out of the gate with a 50 basis point cut. So that's obviously going to whack, T-bill rates right out of the gate. Um, what what counsel would you have to people that have been sitting in T-bill and chill and are now looking out of the future?
I think it's, you still have an opportunity to extend the duration and try to lock in yields, but the Fed's on a rate cutting path. And almost always when they're on a rate cutting path, they cut significantly. I'm not talking about right now, the Fed thinks they're going to cut down to roughly 3%. That's not significantly, historically speaking. Historically speaking, it's 5%, and more recently, bringing rates down to zero. So I think if you're of the mindset like ourselves that yields are coming down, that inflation has been slayed, however, as defined by an economist, that you're running out of time sitting in money markets. And every day going forward, that rate is going to decline as just time progresses. It's just the math behind the way money market funds work. And, the securities they own 1 month, 2 month securities. Every day that goes on, a month from now is a day later and a day closer to the next Fed meeting and the next Fed meeting when the Fed has told you pretty much that they're going to be cutting rates. So, the yield curve is now upward, positively sloped for the first time in, I think it's been over 2 years. And, so right now you're getting a little more yield with a 10-year than a 2-year. Now still the T-bills have higher yields because it just takes a while for them to come down. But, now's the time to react and to think about where you think rates are going. And if you agree with us, it's time to start not chilling anymore and taking action.
Okay, not
Not
chilling anymore.
not
Um,
chilling, Bill.
all right, and of course that's just going to have big impacts for the markets because where's that capital going to go? And I think when I asked you about this the first time, I was saying my prediction, which you long predicted before me, is that some material amount of that is going to go into longer duration bonds, where people have gotten kind of comfortable sitting in safety and saying, I like that. I'm not willing to give that up yet. Yeah, I can see that you know, my T-bill return is gonna go away. So maybe I'll go lock that in for 2 more years or 5 more years or whatever, right?
Well, it's
Where
hard to
else
make
do you think that might go?
it's hard to make the argument that people that have been in T-bills for the last couple of years are going to go to stocks. Right, right. They missed a really nice rally. But they're clearly risk averse. So if you're risk averse, but and you want to stay in a safe security, but you want to earn a little extra, that means you're going to 2 years or 3 years or 5 years, maybe seven. The risky ones go to tens or 30s. Maybe you buy some high grade corporates. So I think the spectrum is primarily fixed income securities, within that treasury securities, and then within that kind of duration based. So I think it's hard to make the argument that someone that's been sitting in bills is all of a sudden going to buy the stock market at record highs and very high valuations.
Yeah, yeah, they're
And
probably not going to go from a T-bill to Nvidia.
no, I think for some bond investors, they're not going to go from a T-bill to the 30-year, which is kind of has a volatility profile, not similar to Nvidia, but on a relative basis, the same thing.
Yeah. Okay. So yeah. So the what do I want to say this? The longer short durations, right? The 2 to 5 years, maybe the mids, the 10 years ish.
Yeah, I
You'll
mean,
see we'll get some capital. Where do you think? And I'm asking you to postulate here, but like, what other asset classes would you expect to benefit from the tide coming out of money market funds and T-bills?
so a lot of that has to do, first of all, when money comes out of something, you create new money that has to go somewhere, right? So if you move out of money markets and buy a 5-year note, whoever owned that 5-year note now has cash that's in
Right.
the money market.
And sorry to interrupt you, but let me just make sure for folks that are going to chime in on the comments. I totally get the cash on the sidelines issue, where cash on the sidelines never changes, right? Because if I have the cash and I give it to Michael to buy something from him, he has to deposit the cash in the banking system. Right. So the amount of cash in the banking system remains constant. Totally get it. What assets that cash is used to buy, though, changes. That's what we're talking about.
Right. And, again, I think at the end of the day, some of that money will go to the stock market. Some of it will go to the junk bond market. A lot of it stays in treasuries or high grade corporate bonds, municipals, higher grade municipals, things like that. I think what matters more for all these asset classes is the economy, is the Fed, is liquidity. And the troubling thing that we face is that the yield curve, I've written a couple articles on this recently, is what's called bull steepening. So that means yields are coming down, prices are going up. That's the bull in bull steepening. And 2-year yields are coming down quicker than 10-year yields. So the curve, the difference between the two, is getting steeper.
Yep. Hey, and sorry to interrupt here again, but it's very important. The 2-10s yield curve has been inverted forever. I'm assuming it's now uninverted and uninverting at a faster rate than we've seen given today's news, correct?
Yeah, it's right now it's positive. It's, right before we got on, it was about plus 10 basis points, which isn't a lot, but considering where it's come from, it's made great strides over the last 3 or 4 months. And I suspect it will continue to steepen, or twos. The difference between 2s and 10s will get greater over time. Both of them coming down in yield, but 2s falling faster. Okay. So unfortunately, what we find in persistent bull steepening periods, and even though this has been going on for a while, I wouldn't quite call it persistent yet, but we're starting to get there, is that stocks do poorly, that a lot of asset classes do poorly. Now, within stocks, staples, utilities tend to hold up very well. Not surprisingly, high beta, technology, some of those type of sectors do poorly. So, just because we're in a bull steepener doesn't mean go out and sell, but it does mean you have to evaluate what you own and think about what type of stocks you want to own, what type of bonds you want to own, and how does that fit into the environment that we appear to be entering into, which the Fed kind of knocked the champagne bottle on the SS economy. We're in a new regime, Adam, and that's what, things have changed. The Fed, I think officially the Fed christened it today, but the yield curve is telling us that we've been entering this new regime for a couple months now. So pay attention, understand what you own, understand how those things that you own perform in different economic, different monetary policy environments, and, adjust accordingly. Doesn't mean you have to do it all today, but just appreciate it so that you're ready to act when the time comes.
Got it. Very important direction there. I get another hypothesis. I'm just curious to hear your thoughts on it. And then we'll get to how you are taking action in your portfolio there at RIA for this new regime. So you said that, some percentage of the capital that's in money market funds and T-bills right now obviously will go into the bond market in ways we discussed, but some of that will find its way into stocks. It's probably not going to, because it's coming from more conservative holders, it's probably going to go into more conservative equities, right? Like you said, the utilities, the staples, the high dividend blue chips, right? Mm-hmm. And I've had folks on in the past recently, like Stephen Bavaria, who I don't know if you're familiar with him, but he's all about building credit-based high return portfolios, right? And basically kind of using the math of bonds to build kind of like equity-like returns, but hopefully with a lot more safety because it's a contract. And the risk you're taking on is just the existential risk of the company. You're not taking on valuation risk or entrepreneurial risk or all those other things, right? And he recommends people build what he calls an income factory of all these different types of things. But I imagine that the types of instruments that would benefit well would be those type of income factory instruments that he talks about. My point is if you're somebody who that appealed to when you heard Stephen talk about it, Well, Michael might be giving you another reason to want to consider doing that, because yes, you'll get the returns of the portfolio, but if this flood of capital goes from T-bill and chill into those instruments as well, you'll also get you should also get some additional price appreciation beyond just the cash flow returns of those.
Right, absolutely. But always be careful with what type of bonds you're buying. Every, other than US Treasuries, which are risk-free, all bonds have credit risk. They all have interest rate risk, but they all have credit risk. And look, we know that Apple or Meta or Google or Exxon are not going out of business. And if you buy a 2-year Exxon bond, they're not going out of business in 2 years. We know that. But if the economy slows and the odds change in the credit markets, that even an Exxon bond can underperform significantly a treasury bond during stressful moments in markets. So, if you, depending on what you buy in the fixed income markets, there is some interest rate risk with kind of implied changes in credit risk. And that's a very important point, because if you're willing to hold on to the Exxon for 2 years, you're going to get your money back. But at some point in the next 2 years, there's a credit event in the markets. You may be very disappointed you bought Exxon and not a treasury. Again, it'll be a temporary blip in price, but as we see with stocks, when they go down a lot, people get scared and they sell. They don't buy more, they sell. And that's, if you understand you're going to hold that Exxon bond for 2 years, you are getting your money back. I don't see any scenario where they go out of business. But that doesn't mean the price just goes from A to B in a straight line. There's a lot of zigzags along the way.
Yeah, and so you're giving multiple reasons, both in terms of complexity, understanding the complexity of the investment, but also managing your emotions. Why we recommend on this channel so often that people, if they're not, very seasoned, experienced investors with these types of instruments, and most people honestly don't have a lot of experience trading bonds or investing in bonds, then you should work with a good professional who's very experienced in this.
Which is,
all
with
right.
that, can we just stop for 1 second?
Yeah.
That always fascinates me, that no one understands bonds and everyone understands stocks. Bonds are a very simple contract with very simple cash flows.
I know.
Stocks, you're just guessing on how much money they're going to make or lose every quarter, and you're putting some valuation on that, knowing even the seasoned Wall Street equity analysts don't know that much about the inner workings of these companies. But everyone knows stocks and no one knows bonds. Bonds are simple.
With this goes to the heart of behavioral economics, and it's a big reason why I founded this channel. Is we are often our worst enemy when it comes to investing, and it's not because it's too complex for us. It's because we're human animals, and the way that we're wired just works against us. We are wired to respond to story. That's what stocks are, right? Mm-hmm. It's a story that we can understand and we can get excited by, and it's also heavily promoted to us as well. So we don't want to discount that part as well. But also as a society, we have kind of told ourselves, unless we're an engineer, that math is hard. I gotta, if there's numbers involved, I got to abdicate my responsibility to somebody else, right? And the crazy thing about bonds is that the math's not that hard. We just don't have experience in it. We have an anxiety that, it's mathy and therefore I'm going to get it wrong, right? But it's crazy, because the fact that it is math, we should be able to make much more predictably good decisions, because the math will tell us what's good and bad. But instead, we go over to the emotional side and we try to determine what story feels best to us.
If nothing else, you understand what you're buying in a bond. When you're buying a stock, you really don't know what you're getting. Are you paying for the valuation? Are you paying for earnings? What are you paying for? You're paying for the story that's being told by the market. And those stories change all the time, and you're betting on how the story changes. It's whatever.
Right. Well, and your risk exposure is so much higher. As Stephen Bavaria clearly laid out for us, both stocks and bonds have an existential risk, right? Okay, the company might not be in business tomorrow, right? But that's the only risk that bonds have. Yeah, there's some relative interest rate risk, but you're still going to get paid back what you're getting promised as long as the company's still around. Then with the stock, you have well, how does it perform? That's the entrepreneurial risk, right? You have market risk. Is it the stock overvalued or not, right? I mean, there's just all these other factors that go in there. And it's like, why would I take on all that risk unless I'm getting dramatically over rewarded for it? And certainly, in recent, recent quarters, the return premium on equity really hasn't justified taking all that additional risk.
Right. I mean, that's at the end of the day, that's all Lance and I do. It's risk reward. Are you getting paid to take the risk? And if not, how do you change your portfolio so that you feel more comfortable that you're getting paid properly to take the risk that you're taking? And, but unfortunately, I think a lot of people at home don't see it that way. They see stories. Like you said, they see confusing math, and they don't put the time to truly understanding both stocks and bonds. And it's easy to listen to Jim Cramer and say, wow, that must be, I'm going to buy some of that. He does a hell of a sales job. And that's what Wall Street does. That's what they do. They sell stocks. Just like every advertisement you see on TV, they're selling something, they're making it look good. All those food commercials, that's not real, that's not their product. Those aren't Big Macs you see on TV. Those are models, and it's half the time it's not even food, it's clay and all kinds of other crap that they paint. They're selling something. And the point is, you need to understand what you're buying and to both understand the risk and the rewards of what you're buying. And I think when you do that, you have a better feel for the markets, and you appreciate why they may be going up, why they may be going down. And if nothing else, you may not do any better, but you'll sleep a lot better.
Well, last point of this, because I got to start wrapping up and I want to get to your trades. But it's why many people, I think, very appropriately and accurately refer to Wall Street largely as a casino, because you walk into a casino, unless you are a skilled statistician, right, and you are computing in your head the odds of, when you get your cards, the odds of what the outcomes are, you're basically just fooling yourself. I mean, you're just there on emotion saying, I feel lucky today, right? Oh, I think I'm pretty good at poker, right? But if you're not actually doing the math, you're, whatever analogy you want to use, you're on the tightrope without a net or whatever, right? You're really just fooling yourself about the outcome. Now, you might get lucky, whatever. Maybe that's the worst thing that could happen to you, because then you're going to, make a big wager that blows up in your face at some point. But it's the same thing with the markets, which is, unless you are doing the gumshoe detective work and really calculating the return on the risk that you and Lance do every day as professionals, then you're kind of fooling yourself. And again, this is a big reason why I encourage people to work with a professional financial advisor. But you got to be honest with yourself, right? I mean, and if you're doing the work, and if you're a good, successful DIY investor who does the work, great, continue doing that if you got a good track record. But if you don't, and I think most people, if they're honest with themselves, would say, I really don't. Leverage the expertise of somebody who is doing that. All right. So getting to the trades here, what trades have you guys made over the past week, if any?
Zero. I knew you were going to ask this question, so I just pulled it up just to make sure I was correct. Last trade we did was August 30th. We bought an agency REIT. This is a mortgage REIT. I'm sure Lance talked about it, Annaly. And basically, they in theory should do very well in a bullish steepener, which we talked about, with yields falling. So we bought 1%. We intend to buy more. We do have a reduced equity position at this time. And we are kind of holding ourselves back to add more duration to our bond portfolio. Bonds have gotten very overbought over the last few weeks, month even. They sold off decently today, despite the Fed. Long-term bonds sold off decently today, despite the Fed cutting rates. They were off a little yesterday. So, we think over time that overboughtness will become fair value, so to speak, and we'll get a better entry price to shift some of our holdings out and pick up more duration. But, we have had ample duration for a while. So if we're wrong and bond yields just keep going down, we also don't feel like we're missing out because we have taken a
You'll buy more.
position a little too far in advance, but nonetheless, we have been on this roller coaster ride for a while.
Okay. And Lance has already made this commitment in my last video with him, which is if indeed yields continue to go up for a bit, but bonds become less overbought to the point where you think they're fairly valued and you guys maybe start moving out in the duration. Lance will keep us updated on that, folks. So you'll know when RIA gets to that point where they're starting to take that action. All right, Michael, well, look, thank you so much for stepping in for Lance. I've got a quick few housekeeping things to mention to folks, and then we'll end it. I had a fun rant I was going to do with you, because Lance and I like to end these on kind of a human interest theme. We don't really have time to do it today. I'll just say that it sort of is all wrapped up in the importance of relationships, which is something that Lance and I talk about a fair amount. But I'm really realizing that as my last child heads off to college here, that's a key family relationship that I'm gonna have to learn how to deal with less of in my life, at least on a daily basis. But also, Ashley, my wife, is a licensed therapist, couples therapist, and it was really fun. We just released a video on this channel this week because folks have been asking, hey, can we get some material on some of the things that you and Lance say truly matter in life? And we kind of boil those into relationships, quality relationships, purpose, and health. And so we just did this video on how to, basically, nurture and foster healthy relationships with a licensed therapist. And it went great. So folks, if you haven't seen it yet, just go to thoughtfulmoney.com/relationships, watch that video. Feedback was very kind. People were very nice to my wife. So thanks for that if you were one of the ones that left a comment. But from the feedback, people are saying, look, this really is the stuff that truly matters. We want to see more material on this stuff. So folks, I will commit to doing more of that in the future on purpose, health, et cetera, whichever elements of real true wealth you guys want us to focus on. And then just in wrapping up here, Michael said much more eloquently than me many times in this conversation why it's beneficial to leverage the expertise of a good professional financial advisor who takes into account all the macro issues we talked about here. So if you've got a good one who's doing that for you, great, stick with them. But if you don't, then consider scheduling a free consultation with one of the ones that Thoughtful Money endorses. These are the firms that you see with me on this channel week after week. To do that, just go to thoughtfulmoney.com, fill out the short form there. You'll be connected with the advisor of your choice. Perhaps that might even be Michael and Lance and the team there at RIA. And just a reminder, these are free. There's no commitment to work with them. It's just a free public service they offer to help as many people as possible. Lastly, just a reminder that we're getting into the home stretch with the lowest early bird discount price for our upcoming fall online conference on Saturday, October 19th. So if you haven't bought your ticket yet, make sure you buy it now to lock in that lowest early bird discount before it goes. To do that, just go to thoughtfulmoney.com/conference. And two quick reminders. One, everybody who registers will get sent replays of the entire conference within 24 hours after it. Michael's going to be there giving us an update on bonds, by the way. I should thank you for that, Michael. So if you can't watch live on the 19th, don't worry, you're going to get the whole conference in video form within 24 hours. And then secondly, if you are a premium subscriber to our Substack, you get an additional $50 off whatever the ticket price is. So that lowest early bird discount I mentioned, you'll get $50 off of that if you act quickly as a premium subscriber. All right. So with that being said, Michael, can't thank you enough for sitting in this week, buddy. I'm going to give you the last word.
Look, we're entering a new regime. I think, like we said earlier, the Powell has just christened the new regime, and you have to think a little bit differently now. Doesn't mean stocks can't keep going up. Doesn't portend anything, but we're in a new regime, and you have to start thinking differently and looking at the economic world a little differently. And it's going to be hard. It's going to be hard for a lot of people to do, but that's the task that's being put upon us starting today.
All right. A new regime requires a new playbook. And so we'll be outlining what that new playbook looks like in these videos on this channel going forward, including those with Michael and Lance. Thanks so much, Michael. Again, really appreciate it. Everybody else, thanks so much for watching.